Hey guys, Stephen Hooley here, and I just want to go over a really quick video on major currency pairs and minor currency pairs in Forex. So let's just do this real quick. This won't take much of your time. Now, what is a major currency pair? There are as many currency pairs as there are currencies in the world. You've heard of the euro, you've heard of the US dollar, of course. That's kind of the world's major currency. You've heard of um, the Swiss franc, you've heard of the yen, all sorts of things, right? The total number of currency pairs that exist changes as the currencies come and go, right? It's a pretty simple concept. If the yen were to go away, there would be no more JPY pairs in foreign exchange, Forex. All currency pairs are categorized according to the amount of volume that is traded on a daily basis for that pair. The currencies that trade the most volume against the US dollar are referred to as major currencies, because again, the US dollar is the major world currency. These include the Euro USD, GBP USD, USD JPY, USD CHF, AUD USD, and the USD CAD. All of the major currency pairs have very liquid markets that trade 24 hours a day, every business day, and they have very narrow spreads. Now, let's break down what this means for you guys. So, liquid and lots of volume is good. Why? This means that there is a lot of money being traded on the currency pair, and it moves a lot. You don't want to trade a currency pair that has low volume, low liquidity, and doesn't move a lot. If you were to place a buy or a sell on a pair that doesn't move a lot, has low liquidity and low volume, you're going to be stuck waiting forever for it to change, right? You're going to be stuck waiting forever to see if you were right or wrong, or even if you know you're right or wrong, it's going to take forever for that pair to hit your TP. So either way, you want a pair that's very liquid, lots of volume, and moves a lot. Now, that's not to say that you shouldn't trade JPY pairs that aren't considered major pairs. Some of the pairs that aren't considered majors still move quite a bit. Like GJ technically isn't a major pair, but it moves a lot. It's very, very volatile. It moves up and down very quickly and tricks people and traps people a lot. So let's move into minors and exotics. So currency pairs that are not associated with the US dollar are referred to as minor currencies or crosses, cross pairs. These pairs have slightly wider spreads and are not as liquid as the majors, but they are sufficiently liquid nonetheless. And that's what I was saying earlier is currency pairs like GJ, I know traders that literally bank off of GBP, JPY, GJ. It's like an ATM. It's so volatile and moves a ton, even though it's considered a minor. But it's not a major, mostly because it's not associated with the US dollar, right? The crosses that trade the most volume among the currency pairs, which the individual currencies are also majors, and some of these crosses are Euro GBP, I mentioned GBP JPY, and Euro CHF. Now, exotic currency pairs include currencies of emerging markets. These pairs are not very liquid, and the spreads are very wide. And I'll break down spreads in a minute. An example of an exotic currency pair is USD SGD, basically the US dollar against the Singapore dollar. There's USD Mexican, USD Turk, USD, there's the Russian one. Basically, these are pairs that unless you really know what you're doing and you can catch a really big move to account for spread and wait a while, these pairs are just not going to move fast. You have the potential to lose a lot of money on them. So just real quick, we'll mention a spread before we end this video, but basically a spread is the difference between the bid and the ask price. Every time you place a trade, you have to account for the spread. So let's say you have a spread that's 2 pips, right? We already went over what's a pip. A spread that's 2 pips, that means if you buy, you have to go at least 2 pips into profit before you actually start making a profit. Plus, you have to account for the broker's commission, which gets built into the spread. So let's say the broker's commission accounts for another 2 pips. That means you've got to catch 4 pips before you actually make a penny. So just keep that in mind. That's why the more liquid and major currency pairs are a lot easier to trade for new people, mainly because the spreads are lower, they move a lot, and you're bound to make more than you're going to lose with them, but that's not to say that you're going to make money. I mean, nobody can guarantee income, right? Nobody can guarantee that you're going to make anything, but you can understand the reasoning behind it all. So now that we've gone through this, let's go ahead and move on to the next video. Thanks for watching, guys.